Okay, so today we're going to be talking about, or we're going to be going over section 4E and 4F. And I'm going to tell you, there's not a lot of math per se involved. We'll do a few little math examples, but the majority of these two sections are really just definitions, terms. It's that real world math that's out in, 4E is over income taxes and 4F is over national finance stuff. So it's more about terminology. So if you're watching the news or reading something about this information, that you'll know what those terms mean. And that's really how it's set up. Hold on, give me just one second. So I'm going to kind of go over it like that, where these two sections you need to read. The test, when it comes to these two sections, will have really definitions pulled out of them, except there's a few again, math computations, but mainly about marginalized tax rate. But other than that, it's more about understanding the words and understanding what they mean as they relate to taxes and as they relate to just the federal. Federal budget. Yeah, that's right. Understand the federal budget. So let's get started. So again, 4E is on income taxes, and it goes over just the basic. Just know those bold words from 4E, okay? And it talks about gross income, adjusted gross income, exemptions and deductions, the difference between those, taxable income, tax credits, total tax, and then, of course, tax refund. And then it goes over filing status, the forms. I mean, it's really more of really just an introduction of taxes. If you don't do your own taxes, this really is a good section to kind of understand the basics, the ins and outs of it. And there's a section on should you itemize. And then what I'm going to talk about really on the math side, so you guys see the math part, is what a marginalized tax rate is, because the U.S. has a marginalized tax rate. And what that means is that the tax rate changes as your income level changes. So if you're under like the lowest amount, I'm on page 257 following along. It gives the 2013 marginalized tax rate with the standard deductions and exemptions. But it has this, like if we look at the single column, look, if you make up to $8,925 and you're single, you just pay a 10% tax rate. Well, then after that, between 8,925 and 36250, that difference is going to be taxed at 15%, and then so on and up. So let's just look at an example. Let's see how I'm looking at their example. Using 2013 tax rates, calculate the tax owed by each of the following people. Assume that they all claim the standard deduction and neglect any tax credits. So let me switch over here to the document camera. Kind of set up. I had to move it yesterday, so it's all out of whack. This is okay. So it says Deidre is single with no dependents. Her adjusted gross income is $90,000. So first off, we've got to find Deidre's taxable income. She's entitled to a personal exemption of $3,900. It talks about that. Like if you look at the column on page 257, at the very bottom, there's an exemption per person, and it says $3,900. So we've got this $90,000. That was her income. Excuse me. Her gross income. And then we take off $3,900 and then $6,100, which is the standard deduction. So minus $3,900 minus $6,100, and you wind up with $80,000. Now remember, she's single, so Deidre is single, so she's going to be with this single column right there. So if I wanted to find her income, so it says now we calculate her income using the single rates in table 4.9. Now, if you notice, she makes 80 grand. And if you go over to the book, 80 grand is in that 25% tax rate. But it's not that 25% of 80 grand is what is taxed. That's not what she has to pay in income tax or federal income tax. She pays a marginalized amount. So again, it's less for, like the very lower portions of your salary, and then it just gets higher as you go up. So what happens is she's going to pay, and I'm going to write it a little different than they do. For that first 8,925, she's going to pay 10% of that. So remember, that's 0.10. That's what that first cell in the single column means. She's going to pay 10% of 8,912. So you know what? I mean, I don't have to do this. I could do this one by hand, but I'm going to pop in the calculator just to make sure. That's going to be $892.50 plus. So then for the gap between 8,925 and 36,250, she's going to pay 15% of that. So I'm going to kind of write it in this bracket. So between 36,250 minus 8,925, she's going to pay, it says 15%, so 0.15 from that amount. Okay, so I'm going to take the calculator and I'm going to say 36,250 minus 8,925. And, you know, we subtract 8,925 because we're paying 10% on that 8,925. We're going to pay a little more for this next margin, okay? So that's 27,325. So we're going to pay 15% of that. So $4,908.75. Now we keep going, right? Because she's in that 25% bracket. So the next bracket, well, this is where she lands, right? The 80,000. So I'm going to take 80,000, her salary, minus that gap. So 36250. And then she's going to pay 25% on this. No, I ran out of room here. So it's going to be 0.25, right? 0.25. That number right there is 0.25. Ran out of room. So let's see here. Let's do this one. So 80 grand minus 362, what was it? 50. That's 43,750. We're going to pay 25% on that. So 10937.5. So if we add these together, that's going to be her federal tax rate. So let's add it together. We get 892.50 plus 4098.75 plus 10937.5. So she's going to pay $15,928.75 in federal income in 2013, right? This was 2013 federal income tax. Is that what they got? Okay, that is what they got. Okay, so think about this. So when someone says, "Oh, I'm in the 25% tax bracket," which Deidre could say she's in the 25% tax bracket. That does not mean she's paying 25% of her income in tax. So if we look at this, actually, I'm not going to do gross. Let's do the adjusted amount, and to see how much she actually paid, right? So I'm going to take that amount and just divide it by 80,000. 15,928.75 divided by 80,000. Now I'm going to multiply it by 100 to get the actual percent that she's paying. So 15,928.75 divided by 80,000 times 100. That's going to be 19.9. I'll write it to the point or the tens place right there. So she's paying at almost a 20%. She's almost paying 20% in federal taxes. So just know that that's how our tax rate is calculated. We don't have a flat tax. That's something that's definitely been brought up in the past, but we have a marginalized tax. So the more it goes up, the higher taxes that you pay for each bracket, right? For each margin. And the book goes on and does like two other examples, which is great. And notice, I mean, if you're married filing jointly, it's a different rate. Married filing separate, and head of household. Great. So, and then your book goes over just a bunch of definitions. I mean, it goes over the difference between a tax credit and a deduction. Should you rent or own? And one of the reasons people rent or own, varying value of deductions, Social Security and Medicare taxes, which is FICA, FICA. And if you guys get a paycheck, you know that FICA, it says it on there. Um, Dividend and capital gains and how they're taxed. So, dividend, we'll stop right here for a minute. So not all income is created equal. Here, let me switch over to myself because this isn't really a lot of math. I'm reading from the book on the bottom of page 260. It says not all income is created equal, at least not in the eyes of the tax collector. In particular, dividends on stocks and capital gains. Profits from the sale of stocks or other property get special tax treatment. Capital gains are divided into two subcategories. Short-term capital gains are profits on items sold within 12 months of their purchase. They are taxed at the same rate as ordinary income, though they are not subject to the Social Security taxes. Long-term capital gains are different. They're profits on items held more than 12 months before being sold, and most long-term capital gains and dividends are taxed at lower rates than other income such as wages and interest earnings. As of 2013, which I don't know if this has changed, we can look this up, but as of 2013, the tax rate for long-term capital gains and dividends were 0% for income in the 10% to 15% tax bracket, 15% for income in all higher tax brackets except the highest, which is 39.6. So it's a way to, if you kind of diversify your income and you use stocks and investments to do that, it's a way to really pay lower taxes in doing so because they're taxed at a different rate. I'm not going to go into if it's right or wrong. That's not what I'm here for. But it is one strategy, and it's and I know it changes. It's a very kind of politicized debate on how they should be taxed. I know if you're paying attention to the news over the last few months with the GameStop, with the stock that blew up. One of the things that was brought up as well was just if you did buy it and then sell it high, just be careful because it'll be the short-term gain. So you're going to pay a lot in taxes because it's a short-term gain, right? It's not a long-term. It's not like you're investing in a company for a long-term, you're trying to make money, retirement investment or anything like that. Okay, there's tax deferred income, which we'll go over that just for a minute because it's one of my favorite things. The tax code tries to encourage long-term saving by allowing you to defer income taxes on contributions to certain types of savings plans called tax-deferred savings plans. Money that you deposit into such savings plans is not taxed now. Instead, it will be taxed in the future when you withdraw it. So a very common example of this is a 401k. It says tax-deferred savings plans go by a variety of names, such as individual retirement accounts, IRAs, qualified retirement plans, QRPs, and 401k plans. So when you put when you put money in your 401k, it's not taxed. So you actually get to defer this. So let's say you made $40,000 a year and you put $2,000 in your Roth IRA. That $2,000 comes off of your gross amount, okay, off of your total amount. So you would make $38,000. So, but what happens is, so it's not taxed at the beginning, it's taxed at the very end. And there's a pro and con to that, right? Because if you put $2,000 in now, and if it was taxed now, say at like 10%, you're only going to pay $200 in taxes, right? But then if you leave that in for 40 years because you're saving up for retirement, you're going to pay a whole lot more in taxes in 40 years because we know from that compound interest section that that $2,000 is going to grow into $50,000, $60,000. Well, paying taxes on $50,000 to $60,000 is a lot more than paying taxes on the $2,000. The Roth IRA does that. So the Roth IRA, you already pay taxes on it, and not this only talks about the IRA. The Roth IRA, though, you pay taxes on the front end, and you don't have to pay taxes on the back end. So it's kind of interesting when it comes to long-term savings on a balance of Roth IRA, 401k, things like that for retirement, because of the tax incentive long-term for a Roth IRA, which is kind of neat. So if you are going to, personally invest. I'm sorry, I don't feel well this morning. It's been a horrible morning. I'm trying to bring it together. I say horrible morning, health-wise. I've just been not feeling well. But let's get back to Roth IRA. This is stuff that I love talking about. So Roth IRA, they tax you on the front end. So what that means is when you take it out after, say, it invests, say $2,000, but you tax it on the front end, and so it's now $1,800. Well, then at the end, when you get it out in 40 years, you don't have to pay taxes on that money. So it's kind of neat, and you can balance that. So if you have investments with a Roth IRA and with a 401k, if you did say your income was made up of half, investments from the Roth IRA and half from the 401k, you would only be taxed on the taxes from the 401k because that was tax deferred, which is what they're talking about, tax deferred income. Okay. Yeah. And that's it. So really from this section, other than being able to find a marginalized income, that's the only math you're really going to have, other than, maybe some basic subtractions about deductions and tax credits and things like that. But there's not a lot of math involved. This is more really about knowing real world things, real world math. At some point now, you might hire someone to do your taxes every single year, but at some point, you just need to know, at least have a grasp of what they're doing, okay, and how it's calculated. So when you go to complain about how much you're paying in taxes, you'll know where or how it's being calculated. Now, not where it's going to, that's a different topic for a different day, but actually it's kind of in the next section with the federal budget. But just know that this is the basics of how it's calculated, okay? And then for homework, let me just make sure I've got it'll be the homework that's in Blackboard. Hold on. Make sure I'm on the right page here, course schedule. Come on now. There we go. Yeah, for homework, it's going to be 1 through 67 odd. Yeah, 1 through 67 odd. And a lot of it is just kind of not subjective questions, but what's the difference between these two things? Make sure you know the difference. And then like number 3, what are exemptions and deductions? What does that mean? And on the test, I might ask you, give an example of each, right? What is it? And give an example. That's a good question. Okay, I'm going to pause for a minute before we go on to 4F. A lot of sections in this test. Do you guys, you two that are in here, do you guys have any questions about income taxes? I'm not an income tax pro by any means, but I don't mind answering any questions. You can pop in the chat. You can jump over. Either one's fine. Okay, let's keep rocking and rolling. So let's get now to 4F. And I'm going to tell you 4F is really a definition section. It is not a long section. I believe 4F is like 4 or 5 pages. But it's really about knowing the words and what they mean. So 4F starts on page 266. And it goes over it calls it budget basics. I mean, just very, very basic budgets. We need to know that receipts mean just income. So represent money that's been collected. Outlays are just expenses. So if you hear those terminology, receipts are money you've made. It's outlays. Yeah, outlays are money that you had to spend. And then net income, of course, is just receipts minus outlays. And of course, if net income is positive, right, you're in a surplus. And then if it's negative, you're in a deficit, right? So if there's more expenses than or more receipts than outlays, you're in a surplus. You got more money. And if you have more outlays than receipts, then you're running a deficit. You're running in the red, which is not good. And we got to fix something. And your book then goes over debt versus deficit. A deficit represents money that is borrowed or taken from savings during a single year, where debt is the total amount of money owed to lenders, which may result from accumulating deficits over many years. So debt isn't necessarily a year-to-year thing. Debt is a long-term thing. We owe, like, I have a debt to my mortgage company, right? Because I owe the mortgage company that mortgage amount. So that would be considered a debt. A deficit, though, is just money that is borrowed or taken from savings during a single year. So if I took out money over a single year, that would be a deficit. Or for that year, I should say, is a deficit. The book does good examples of this with small budgets or small business analogies. And then it goes into I need to get, the one thing about using the older book is that it's 2013, 2014 data, is that you don't get up to date, national budgeting stuff, which can be kind of fun. it can be kind of fun to see where we're at. But your book goes over the surplus. This is on page 269. It goes over surplus or deficit, and then the gross federal debt. So notice the gross federal debt is growing. And hold on, let's see where it's at right now. I'm just going to do a quick Google search. It says in 2019, I just quick Google search, 2019, we're looking at 22 billion, which, that kind of follows that trend, right? And about 14 or so, 2013, it's at about 17 billion. Yeah, and that's following what the data is showing here too. So the surplus or the deficit, though, I mean, I think the last surplus was under Clinton in the late 90s. Could be wrong. Hold on. Let's see. Last federal surplus. I'm just interested now. Oh, 2001. Surplus occurs when the last surplus for the federal government was in 2001. Oh, right there. Yeah, so it was under Bush's first year. Okay, we're looking at second year. No, for sure. So kind of neat there. I mean, it kind of shows you what's going on. And of course, we I even just relayed that to like presidents. Like for some reason, it's a president that causes a deficit or a surplus. It's not always a president, right? It's really what's going on with the economy. There's a lot of factors involved, a lot of variables. It's just we typically remember them with who was president at the time it occurred. I say me. That might be just a me thing. Federal debt goes over more in 270. And look, we've got deficit spending, and then we had this gap in late 90s, early 2000s where we actually had a surplus, and then it went back to deficit spending. I'll tell you what's different about the state of Arkansas is we can't have that. The state of Arkansas has a law that says we have to have a balanced budget, so this will not occur in Arkansas. It causes some problems whenever we need to spend, but then also we don't need to spend when we don't have the money, right? It's a basic kind of tenet there with budgeting. So the state of Arkansas has a balanced budget law. We can't do this. And now the federal budget, though, does not have that law. As you can tell, it is running in the majority of time and in a deficit spending since 1970. GDP, though, is a little different. Yeah. Gross domestic product book. Define that. Yeah. It says figure 413 shows spending and receipts for several decades as a percent of the GDP, the gross domestic product, which is the most commonly used measure of the overall size of the national economy. Does it define gross domestic product? Dollars. Well, let's define it. It doesn't look like your book really does a good job of defining gross domestic product, just so we have one out there. It's weird that it doesn't do that. The gross domestic product is the total value of goods produced and services provided in a country during 1 year. So the total amount of goods and services produced by a country, I'm stealing Google's results there. The total amount of goods produced in a single year. So that's, if you see the word GDP, that's really what that means. And then it goes over mandatory. Yeah, there's the book, the page on 272, it goes over just pie charts on where things are going, where the revenue is and where the spending is. So you can see individual income taxes, which we just talked about, right? That accounts for 47%, roughly 47% of the federal revenue. Receipts from Social Security, Medicare, and other social insurance receipts are 34,000. And then, we've got corporate income tax, excise taxes. You can look those up. And then, the other 6% for other. The spending, though, is interesting. The defense and homeland is 19. What's the largest? Medicaid. Medicaid, government pensions, and other mandatory spending. So that's 26%. And then defense, national security is a big chunk. It's the defense and home security, and then non-defense discretionary. And then Social Security and Medicare. And then interest on debt. So we have to pay 6% there is interest that we have to pay on the debts that we have. All right. So 6% of our federal spending goes to debt. And that is what I believe has been increasing over time because our debt keeps increasing. And your book goes over that a little bit. Interest on the debt. Yeah. Oh, yeah. And then it talks about strange numbers, publicly held and gross debt. This is the next page. There's two kinds of debt, and I'm reading the green box right there. The publicly held debt or net debt represents money the government must repay to individuals and institutions that bought treasury issues. And then the gross debt includes both the publicly held debt and money that the government, owes to its own trust funds, such as the Social Security Fund. So two different kinds of debt, and your book goes over the differences in those debt. And then, the budget. Okay. This is the next page. The unified budget represents all federal revenues and spending. For accounting purposes, the government divides the unified budget into two separate parts. The portion of the unified budget that concerns Social Security is considered off budget, and then the rest of the unified budget is considered on budget. So unified net income minus off budget net income equals on budget net income. You don't have to worry too much about that. I'm not going to ask that on the test, but it's more about this section is really more about understanding the basics of the national income, deficit, debt, things of that nature. And then, so that's it. I mean, there's no math. There's no real math in this section. It's really about definitions and understanding real world mathematics and things of that nature. So it's not really a deep, formula section by any means. These last two aren't. It's really more about definitions, and you need to know those bold definitions in both of these sections. So that the homework for this one isn't as long. It's 1 through 50 odd, so it's like 25 questions. So 1 through 50, you could probably do 1 through 45 even and be fine. But 1 through 50, 1 through 45 odd in this section. A few housekeeping things before we get done. Your rough draft is due today, right? I'm not wrong on that. So get that turned into me today. Yeah. The test 3 is going to be on Monday. So I'll have that in Blackboard on Monday. So you'll get test 3 done on Monday. If you guys have any questions, issues, concerns, please email me. I've had a lot of people email me, which is great. And it can be a specific question. It can be a very general question. It doesn't matter. If you feel like you're a little lost in the class or whatnot, just email me so we can get you on track. This is one of the toughest parts about having these type of classes, the online, the Zoom, is that it's easy to feel kind of a disconnect from the actual classroom, right? There's no classroom. So if you feel like you're struggling, if you just need some help, whatever it is, I'm here. I've got office hours daily. I'll tell you, my Fridays are more open to if you want to have more of like a face-to-face or a Zoom kind of talk, that's fine too. I say talk, just meeting. Just know that I'm here and we're halfway done with the class, which is nice. Okay, so again, rough draft is due today. The next test 3, will be on Monday. You guys have any questions in the class? Ava, Weston, do you guys have any questions? I'll stay on for just a minute.